Amigo loans were considered high-cost credit primarily because of their high interest rates, which led to a very high annual percentage rate, APR. While they marketed their product as an alternative to payday loans, they were still significantly more expensive than traditional bank loans. Why the APR was so high? The main reason for Amigo's high APR was the risk they were taking on. They specifically targeted customers with a poor or limited credit history who would not be approved for a conventional bank loan. Lending to these individuals is inherently riskier because of the increased chance of default. To mitigate this risk and still make a profit, Amigo charged a much higher interest rate. Their representative APR was typically around 49.9%. This meant that over the course of the loan term, borrowers would pay back a huge amount in interest, often more than the original amount borrowed. For example, a loan of £2,500 for 36 months would result in a total repayment of over £4,390 due to the high interest rate. The role of the guarantor. While the guarantor model reduced the lender's risk, it didn't reduce the cost of the loan for the borrower. The guarantor's promise to pay if the borrower couldn't was the security Amigo relied on. This allowed them to lend to people with bad credit without needing collateral, but the high-risk nature of the lending was still reflected in the cost to the customer. The high-cost nature of the credit and the reliance on a guarantor often led to financial hardship for both the borrower and the guarantor, which was the central issue in the numerous complaints and regulatory actions that ultimately led to the company's downfall.